Australia's central bank had shocked pretty much everyone last week when it decided against cutting rates. Officials down there said they were going to pause since urgency over their next rate move seemed to have died down. But that's how it goes in these rate cutting cycles. They are littered with pauses. But central bankers always go back to cutting rates because the weakness never goes away. And it only took a week for the week in Australia to show up again, where the country just reported its highest unemployment rate in 4 years. The pauses, they just don't mean much. And Australia is not the only one. The Bank of England just paused its modest rate cutting last month too, and largely for the same reasons. And just like in Australia, today the British government reported a sharp rise in the unemployment rate, which is also now the highest in several years. Two central banks that went on hold recently aren't going to be able to stay there for very long. History is not on their side, and as it is quickly turning out, neither is the data they claim to depend on. Rate cutting really is a Pringles policy. Once any of them pop, none of them can stop, no matter how much central banks around the world and throughout history might want to. They don't like lowering rates because that means economic weakness, therefore reflects poorly on them since they all claim to control the economy. And here in 2025, the lower their policies go, the less they can talk about the soft landing that they've been promising for years. Central bankers are always looking for reasons to stop, claiming a few rate cuts are powerful support so they only need a few, or that the economy is just experiencing a minor inconvenient soft patch. And it never works out that way. So rate cutting cycle pauses are entirely common. Even multi-month pauses like the one Fed Chair Jay Powell is currently practicing. The Fed had even paused rate cutting throughout the entire middle of 2008. Eventually, the data shows rate cuts were worthless, that economic decay kept right on going, and even those central banks on prolonged pauses, they have to pick up the Pringles can all over again because once they popped, they really couldn't stop. We got two really good warnings here today from Australia and the UK. Warnings for the central bank, sure, but more importantly on the economy. The weakness continues to go a lot longer than you think, therefore rates continue to go a lot lower than everybody is prepared for, up to and including central banks who would rather stop cutting rates and talk about anything else other than why they have to keep going. So starting with Australia, back in May, the RBA, the Reserve Bank of Australia, conducted its second rate cut after becoming the last major central bank to lower rates in February of this year. At that May meeting, RBA's governor, Michelle Bullock, she told the assembled reporters, and we talked about this at the time, that her committee had discussed the possibility of lowering their policy rate by 50 basis points. So they went from ultra hawkish to suddenly ultra dovish, seemingly at the drop of a hat. Now, she said it wasn't the base case or anything, that it was just an open topic for consideration. Why did she tell the reporters that? Because conditions in April and May were not looking good, and it looked like there might be a faster slide toward a more serious downturn in Australia as well as around the rest of the world. It was an exercise in proving that rate cuts are nothing more than announcements intended to influence psychology. The idea was to try to calm markets and the economy by reassuring everyone the RBA would act forcefully if it ever needed to. It's all about psychology, not actual financial conditions. So while everyone had expected the RBA would need to, meaning a third cut in the series here earlier this month, instead the Reserve Bank of Australia paused its rate cut, shocking pretty much everyone. The psychology was no longer needed, they said, at least not at that specific moment. In her statement, Michelle Bullock said, "The likelihood of a severe downside scenario associated with a trade war, which we set out in our May statement, that likelihood has abated." Now, this is a very fluid situation, she continued, and we will continue to watch the data here and overseas very closely to see how it plays out. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. So they're ultra dovish in reaction to the events of April and May, and then when it didn't turn out to be the worst case scenario, psychology, at least their read of psychology, dictated a somewhat subtle shift in their policy, more so the timing of rate cutting rather than the direction of travel for the Reserve Bank of Australia. As Robert Thompson, who was a strategist at the Royal Bank of Canada in Sydney, wrote, "It's a shock for the market that July hasn't been delivered, but key language around inflation suggests that they're just kicking the can down the road to August, which is pretty much a lock now to the market. So that's tempering the hit and ensuring terminal rate pricing doesn't kick up too much." Meaning, for whatever reasons the Reserve Bank of Australia might come up with, they might say that they're pausing here to assess the economic situation both locally as well as globally and keeping their eye on what they think of as inflation risk from tariffs. It doesn't matter anyway because the situation is what the situation is, and the central bank will always at the end have to respond to it. They may want to pause, but their ability to pause and maintain that pause is why it's only ever a pause. They're going to pick up rate cutting at the end of the day, before the end of the year, because the situation in Australia is deteriorating, not maintaining or stabilizing. Their worst case fears may not have happened, but that doesn't remove every single bad case from the potential scenarios. So RBA went slightly hawkish after the post-tariff bounce showed up in the markets, meaning the urgency to the Pringles policy died down. But the RBA is still on the Pringles plan because once you stop, you can't stop. And we see that in the economic data. Starting with GDP. GDP had shot up to a 0.6% quarterly rate in the fourth quarter, then disappointed by slowing sharply to just 0.2% in the first quarter, which was well below expectations for a 0.4% rise. That almost flat reading in the first quarter was where GDP had been from late 2023 into 2024 before the modest acceleration in the second half of last year. Where have we heard that before? Which Q1's estimates indicate was nothing more than an artificial high that's already wearing off by the time we get to the second quarter of this year. But the real news, the real shocker for Australians, the payroll data and the unemployment rate here for the month of June. The worst case scenario that RBA was thinking back in April and May not actually be off the table because the unemployment rate in Australia has spiked pretty sharply here over the last couple of months to the point that the June rate is as high as it's been since 2021. Employment growth has weakened again. Payrolls were basically flat in both May and now June, at least according to the latest data that just came out. So the 6-month average for Australian payrolls is just 15,000, and it's been around that low rate all year with usual Aussie monthly volatility by the month in between. But as a result of this slowdown in employment, unemployment has picked up. The unemployment rate had been rising up to around last year, 2024, but also like the US official rate, joblessness in Australia appeared to plateau and stabilize. There was some weakness earlier in 2025 with a payroll plunge in February, and that's what got the RBA started with the Pringles. That's when they first popped the can. But the unemployment rate was still steady around 4.1%. But now after 2 months, the 2 latest months of no job expansion, the official unemployment rate for Australia popped all the way to 4.3%, the highest since November of 2021. And as Bloomberg put it today, Australian unemployment unexpectedly climbed to a 4-year high in June, as hiring almost stalled, suggesting a loosening of labor market and bolstering the case for the Reserve Bank of Australia to reduce rates next month. The yield on policy-sensitive 3-year government bonds fell almost 10 basis points today, while stocks advanced because stocks are convinced lower rates are good for equity somehow, even if the economy falls off. Money market bets firmed to fully price a cut in August, and after that, with a better than 50% chance of a third. And it really is a probability that the market is saying the probability that rates are going to go lower is increasing, and the probability that rates are going to go substantially lower is also increasing. This data is crucial for RBA policymakers as the resilience of the labor market and worries about it rekindling price pressures, which is not how inflation works, have been key reasons why they've shown patience in the current easing cycle, including what happened here in July. The central bank has cut twice since the start of the year, shocking the market last week with a decision to hold at 385. And today's weak jobs report, following a subdued reading in May, could suggest a turn in fortunes. Now, they mean, I think, the central bank, but really it's about the economy, and therefore rate cuts being a reaction to what's happening in the economy, which means central banks that pop the can and start with their Pringles policy, they don't go in a straight line. They always want to stop. They would like to do more than pause, but the reason it only ever adds up to a pause is because the weakness doesn't go away. Once they pop, they can't stop, even if they don't go in a straight line, and even if they pause several times all along the way. The same is likely to hold true over in merry old England, with the Bank of England and the UK economy that continues to show, in addition to rising consumer prices if because of oil, but more importantly, a rising unemployment rate as well. The Bank of England had been widely expected to hold their policy rates in June after they had lowered them in May, and it did, though with less of a margin than had been predicted. Back in May, the Monetary Policy Committee at the Bank of England was split, with 5 voting for the rate cut, 2 who voted for no change, and 2 who were urging for a 50 basis point rate cut. Fast forward to the next meeting in June, 6 voted for doing nothing, while 3 were in favor of doing some more rate cuts. It was supposed to be 7-2, and so in some ways it looked like the Bank of England, even in voting for its pause in June, was slightly dovish in doing so. But those who were voting against the rate cut, those who were voting for the pause, stressed the quote-unquote uncertainty over tariff price changes, but also they were emphasizing at the time, if you remember, crude oil. Speaking with BBC, Deputy Governor Claire Lombardelli said, quote, "We've seen oil prices, for example, increase since the attacks in the Middle East. But we're thinking about and focused on the impact for UK inflation, and so we're monitoring and carefully assessing those events." And then the ONS, the UK's Office of National Statistics, reported that the UK Consumer Price Index rose by 3.6% in the 12 months to June 2025, which was faster than expectations and up from the 3.4% rate in May. And what drove the CPI rate to its highest level in about 18 months? Transportation. As the ONS wrote, transport, particularly motor fuels, made the largest upward contribution to the monthly change in both CPIH and CPI annual rates. So while for some that might be evidence for inflation, but what was really evidence for is the effect of the oil price spike on UK consumer prices overall. And since oil prices are substantially lower since then, that's not going to repeat. And so while the Bank of England still may cast a wary eye on consumer prices for a variety of reasons, including, like Jay Powell, worried about tariff-driven inflation that still is absent pretty much everywhere, they also have a much bigger and growing problem in the labor market that just will not go away. The latest data shows that payrolls in the UK fell by just more than 41,000 in the month of June, making the 5th consecutive month of payroll declines. In fact, over that 5-month period, jobs have fallen by around 142,000 or 143,000. That has meant the unemployment rate moved up to 4.7% in May. That's the latest data they have for the unemployment rate, up from 4.6% in April. Though we have to note there's often significant revisions in the short run period. But the data that we do have now almost certainly will show the unemployment rate rising for the UK to 4.8% in June. At 4.7% in May, it's already the highest since July of 2021. And outside of 2021, it's the highest since 2018. And just like in Australia, the UK jobless rate had been relatively steady throughout 2024. And now all of a sudden here in the middle of 2025, it is unexpectedly picking up all over again. As Bloomberg reported, The UK jobs report showed a broad-based, they call it cooling, it's a little bit more than cooling in the labor market, that strengthens the case for more rate cuts in the coming months. Once you pop, you can't stop. BOE Governor Andrew Bailey has highlighted the deteriorating labor market as he guides markets toward more reductions, with traders putting the odds of a quarter-point cut next month at over 80%. So like we see around the rest of the world, central banks say inflation, pause, lack of urgency in the bond markets, and more of the fixed income markets like swap spreads and swap markets say you're only going to pause for a little while before you have to pick up with the rate cutting all over again. Pringles is still in effect because the economic fundamentals have not changed. Maybe central bank interpretations of those fundamentals do change, and that does account for these pauses that we see not just today, but also historically. Their perceptions of how things are going swing back and forth, but the trend remains the same regardless. As I said in the introduction, these pauses are common. We saw a big one just this year in Sweden. Now remember, the Riksbank, as I pointed out, had been aggressively cutting rates up until January this year. They started out from a peak of 4% in May of 2024 and brought their policy rate down to 3.25% by September last year. But then they accelerated, with weakness accelerating across the Swedish and the global economy. They dropped their rate by 50 basis points in November, which were followed up by 2 more 25s in December and January. Again, the irregular schedule for rate cuttings. But by January, officials didn't just say that they might be done. In January, they outright stated that they were at their terminal rate. They were down to 2.25%, and they were never going to go any lower. They said they had done enough. These aggressive rate cuts were more than enough to support even a sick Swedish economy. But as it has turned out, as it almost always turns out, that wasn't the case. So while they had thought they had done more than enough to make sure Sweden's recovery was on track, there never was a recovery. That's what the data showed. While it looked like there was possibility for one, there was a short-run pickup, which was more like some temporary stability. The downturn simply reignited here in 2025 because rate cuts don't matter, and central banks' interpretations of the situation are almost always wrong. So even though Riksbank said it was done and had paused for almost 5 months by June, they picked right back up on the rate cutting last month, and they're going to keep going and keep Pringles policy going for more than the rest of this year. But rate cutting cycle pauses are not just in 2025, nor are they just among foreign central banks. We see rate cutting pauses throughout the Federal Reserve's history. The most infamous rate cutting pause was right in the middle of 2008. If that was a pause, if ever there was one to highlight, it's that one. The Fed had started under Ben Bernanke with a 50 basis point rate cut in September 2007, followed up quickly by 2 more 25 basis point rate cuts. In January of 2008, as those initial rate cuts did absolutely nothing, nor did the introduction of their quote-unquote liquidity programs, in January 2008, the Fed was cutting rapidly. It did a series of a 75 and then a 50 in the span of just 2 weeks. Again, talk about the irregularity of rate cutting cycles. They would follow that up in March with another 75 in the aftermath of Bear Stearns, and then one more at 25 at the end of April. But from April all the way through the summer of 2008, as the Great Not Recession was becoming a Great Not Recession, as the deflationary conditions in the monetary system and across the banking sector were getting worse, the Fed stood pat. They did so because they thought the economy had avoided a recession entirely, had avoided the worst case, and they believed in the banking sector and the monetary system that Bear Stearns had been the worst of it. They were more focused on, get this, inflation. Oil prices were soaring. CPIs were therefore rising, just like they're talking about in the UK now. And so they were going to pause because they thought the economy was stabilized, and they were more concerned they would have to raise rates at the end of 2008, before the end of 2008, to get a handle on what they thought was inflation. So they paused from the end of April all the way to October, a period of more than 5 months. The Fed didn't even cut in September 2008 because it had been far more focused on the inflation and oil prices. So even as the economy and the banking sector were collapsing, the FOMC remained more worried about inflationary impacts, which were behind the real reason behind what they thought was the end of their rate cutting, but what turned out to be merely their pause. So the Fed oftentimes, like all these other central banks around the world, they want to stop cutting. They say there's every reason to stop cutting until the data that they claim to depend upon shows that they were wrong for the reasons they stopped in the first place. So all these central banks start cutting rates, and they're already looking for a place to stop straight away, right from the get-go. It isn't just because of unnecessary inflation fears. In the case of 2024 and 2025, the rate cutting cycle that we see globally, all these central bankers all over the world, they also fully believed in the global soft landing. So every rate cut that they do takes them further and further away from where they really want to be. It's like the scene from Godfather 3. Every time they think they're out of rate cutting, unemployment pulls them right back in. The Reserve Bank of Australia and Bank of England, they're two prime and very current examples. Both of those central banks want to pause, but they're not going to be able to. Rate cuts don't help. They don't do anything. And they're always nothing more than the official reaction to weakness that right now is showing up in the worst place, unemployment. So with clear and rising weakness in Australia and the UK, down those rates are going to go, whether they want them to go or not. And this is a warning, not just for those economies, but Jay Powell, are you listening too? And yes, we can see considerable weakness in the U.S. economy right now, especially discretionary spending on services. That has led to deflation in producer prices rather than tariff inflation. All the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.